please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
India's export growth has largely been stagnant over the last 8 years. In fact, here are some hard facts. 6 years ago, we exported goods and services worth nearly $250 million, and this has largely been the reign since 2012. Last year, India's exports amounted to $243 billion. On a monthly basis, the numbers are volatile. For January, exports dropped to $24 billion. In September last year, it was just under $29 billion. In a bid to shore up exports and lift domestic manufacturing, the government has hiked customs duties on a slew of products in the budget. The centre has defended the move, saying it's not protectionist and that the government is well within the conventions of the World Trade Organization. So is a customs duty hike the best way to bolster Make in India? Joining me now to discuss this is former Vice Chairman of the Planning Commission, Montek Singh Ahluwalia. Sir, I appreciate you joining us here on CNBC-TV18. You believe that this is in fact a reversal of policies followed over the last 26 years by successive Indian governments, and this is a move towards protectionism. It is contrary to the promise that the Prime Minister made in Davos about an open India and about an open economy. The government's argument is that this is being done to make in India. Do you believe that this is the wrong way to make in India?
Well, I've made that plain in my article, and I've consistently held the view that, protection is not the right thing to do in order to make in India. I mean, it's very important to do some making in India. And there are many things that we need to do to promote a Make in India campaign. The wrong thing to do is to raise customs duties. Now, it's quite irrelevant to say that this doesn't contradict our WTO obligations. Because the truth is, our WTO obligations, we had set them years and years ago at a very high level. And the idea was that as part of the Doha round, which seems to have collapsed, these would get lowered. So the fact that the existing bound tariff rates allow us to raise tariffs is not a justification for raising them. I mean, in these 26 years that we've been lowering tariffs, different governments of different political parties, we've been consistently lowering them below what the WTO rates allowed. So that's not a relevant consideration.
Okay, if that's not a relevant consideration, we're also trying to understand why the change of heart, because as you rightly pointed out in your article as well, that the Niti Aayog, when it presented its plan for India over the next few years, said that customs duties should be unified at a rate of 7%. And there seems to be a departure, a move away from what the Niti Aayog had put forward publicly. In the budget, we've seen hikes across 50 different items, largely in the food processing area and outside of it as well. What do you think is the reason behind this change of heart or this change of strategy?
Well, of course, I can't provide any input on what the reasons are. We have to go by whatever the budget speech says and maybe what government spokesmen have said. What concerns me, though, it's not just the raising of customs duties. We have a strategic policy of what is called the Act East policy. We are faced in a geopolitical world which has changed dramatically. Now, I start by the assumption that it is in India's interest to integrate with the other countries of East Asia. This is the rapidly growing part of the world. This is the part of the world that is not turning protectionist. This is the part of the world that has built value chains. Now, by raising customs duties, we're actually going exactly opposite of what we should be doing. And I don't know what the reasoning behind that is. Does it mean we don't believe in value chains? Does it mean we don't actually want to act east? I think we need clarity on this. Part of the problem, in my view, is that and I've said this in earlier governments also, the secrecy associated with the budget is a disaster. In a modern economy, I mean, options need to be thoroughly discussed. And unfortunately, we've continued this ridiculous British practice of maintaining secrecy in the budget. Now, one great advantage of, say, something like the GST is that we can forget about sudden surprises in excise, I mean, in the GST rate. And the only area left then for quick surprises is customs. But in my view, that would be a real disaster, because globally, the trend for any sensible developing country is to move towards much lower rates of duty and less dispersion. It doesn't make sense to have 40% duty in one item and 10% and 5% and 3% in the other. Now, I'm keeping agriculture out of this because everywhere in the world, agriculture is different. So everything I'm saying is about manufacturing. I think it would be good if we had a clear statement of policy. And I think the Niti Aayog formula is a good one. I mean, what it would say is, look, telling the rest of the world, they're kind of going to unify around 7%. Incidentally, the East Asian, this will still be 2 to 3 percentage points higher than the East Asian average rates. But at least it would move away from what we're doing at the moment. And then we should just lower duties which are much above 7%, and maybe even raise some of the ones that are at a lower level. We would have a sensible customs duty policy. You know, customs is not meant to be a revenue-raising source. I mean, around the world, good practice suggests that you shouldn't use customs as a revenue-raising source. And I mean, I have one other point.
You know, that was the question that I put to the CBC chief, Mr. Ahluwalia, whether this was a revenue-raising exercise. And Vanaja Sarna's response to me was that no, we get about 6,000 odd crores, so this is not really about raising revenue.
Fine, I mean, okay, then you have to justify it on what grounds, I don't know. See, the question, the real issue is, I believe that Indian manufacturers may be under some pressure. But the solution isn't to raise customs duties. What we've got is a situation where the real effective exchange rate, that's the sort of exchange rate against a whole bunch of countries, I think 36 countries, has appreciated in real terms. Now, appreciated in real terms means after adjusting for price changes. If you look at last January this year and compare it with January 2014, then the real appreciation is 19%. Now, you can change the dates and maybe it won't be 19, it could be 13, it could be 14, but there's absolutely no question that the real exchange rate is sending an anti-Make in India signal. And what's not clear to me is, what is our policy about the real exchange rate? I mean, are we trying to stabilize it or not trying to stabilize it? You know, one of the points I make in the article is that we've built a reasonable architecture on how to look at fiscal issues. I mean, there's some glide path, ratio of debt to GDP, ratio of fiscal, etc. You can quarrel about what they should be, but it's very clear that they define the area of debate. Similarly, on monetary policy, in the sense that, you know, we've got a target inflation rate maximum of 6%. So you would expect that, you know, if inflation goes near 6%, well, the interest rate is going to be raised. We have absolutely nothing on the real effective exchange rate. Now, suppose the governor of the Reserve Bank manages to keep inflation at 5%. Now, he would be legitimately saying that, look, he's kind of within his target, a bit above the 4, but is well within the range. But if the rest of the world is experiencing inflation at 2%, then the 3% difference amounts to a real effective exchange rate change. Are we going to make sure that we can compensate that or not? And I think we need clarity on this. I mean, otherwise what happens is you neglect this for 3 or 4 years. What is it that you would like to see on that? And then industry screams, and then you do the wrong thing. You raise customs duties. And I fear that whether they say it or not, the temptation to raise customs duties is there because you've got fiscal pressure.
Right. But, you know, since you talked about why you believe that the exchange rate has now become unfavorable, and the response, whether it's from the Reserve Bank or the government, is that market forces will determine where the exchange rate is headed. In that scenario, then, what is your ask? What is the expectation from both the Reserve Bank as well as the government when it comes to the exchange rate? Because that's the response that, that one gets.
I know I mentioned, by the way, I'm guilty of inventing some of these formulas earlier. So I'm not saying they're doing, this is what we've said in the last 15 years. But you know, in the early stages, when we were liberalizing, The real concern was that, you know, the exchange rate might depreciate too much. And then people were very scared that, look, we can't have too much of a depreciation. So we invented this, look, you can't rule out a depreciation, but we'll intervene to stabilize. Now we're in a different world in which capital account is much more open. It's not fully open, but it's much more open. And so money can be flooding in because of what's happening elsewhere in the world. Now, if that money floods in and raises the exchange rate, do you mind? You want to leave it to the rest of industry by saying this is a market-determined exchange rate? It's not a totally market-determined exchange rate because, you know, you don't allow capital outflows, you encourage capital inflows. Now, when we argue, let's say, when we criticize the IMF, that these fellows want an open capital account with complete flexibility, which is unreasonable because it can push the exchange rate to unreasonable levels, that's like saying, well, we want to retain some control over the exchange rate. All I'm saying is, let's clarify what it is. That formula is a singularly uninformative formula.
Since we're talking about what these duty hikes will in fact mean for Make in India as well as for exports, do you believe that we've actually given China an advantage by hiking customs duties today?
Well, I don't know whether we've given them an advantage. I mean, lots of people have complaints about China's imports being underpriced. I mean, not just us, around the world. But the point I want to make is that if you want to deal, everybody agrees, by the way, that if you're going to have unfair trade, then you need to put on countervailing duties.
Yeah, but that's a separate story altogether. Exactly.
But
countervailing duties, safeguard duties, that's a separate story altogether. Yeah.
Yeah, exactly. So what I'm saying is if that's a problem, that should be handled that way, not across the board duty increases. Now, whether this has given China an advantage, yes, it gives China an advantage in the sense that in the rest of East Asia, China comes out as a country clearly committed to an open trading system and willing to let its kind of markets be as open as they were earlier and certainly not raising any duties. We've given a contrary signal. In that sense, you might say that we're giving China an advantage. I think we should have stayed the course. And let me say that, you know, nobody would have objected if we had tried to nudge the exchange rate to a more favorable position. You know, the big point about the exchange rate is that it not only helps the import competing industry, but it gives an equivalent benefit to the exports. What the customs duty does is it sort of hurts consumers, helps the people who are producing these particular products, and is a disadvantage for exports. Because, I mean, look at it this way. If you put a 10% increase on customs duties for 50 products, if you were to depreciate the exchange rate by 10%, you would have the same benefit to the import competing industries, but a huge benefit to exporters. And exports are not doing well.
Right.
And they've not done well for the last 2 or 3 years. Yeah. So take a holistic view.
Okay, you know, let's move away from China and talk about possible action from the US, because President Trump has publicly spoken about tariff barriers when it comes to India. He keeps bringing up the Harley example. He said that, you know, the fact that we've actually reduced duties on Harley is not good enough. A lot more needs to be done. He's also threatened reciprocal action. You know, how concerned should we be about that possibility?
Well, you know, obviously I don't support what President Trump is saying. I mean, he has a right to make his demands like every country does. And the Americans for years have said that we have actually got very high duties on certain products that they're particularly interested in, and Harley-Davidson happens to be one of them. That's a separate issue. You know, in terms of retaliation, I mean, if President Trump feels that we're doing something wrong, he should go to the WTO and seek the permission to do whatever is necessary to counter that. International trade law rules out unilateral action. I mean, unilateral action is actually a denial of the notion of rule of law in international trade. Now, unfortunately, and this is not just President Trump, the United States for years has reserved the right to take unilateral action under the Super 301 and 301 provisions of the U.S. Foreign Trade Act. Now, you know, so far, frankly, the bark has been worse than the bite, because they haven't actually taken action against us in that area, but they keep threatening it. You know, I think more generally, I hope that the U.S. administration will adopt a much more supportive line on the need to keep both the U.S. economy and therefore the global economy open. Because there's no question that when people hear the United States uttering protectionist sentiments, it makes those who want to push protectionism look sensible and contemporary. And that's unfortunate.
Well, we will take a break on that note. Mr. Ahluwalia, stay on with us. Here's the CEO of Mercedes-Benz in India speaking out against the customs duty hike. Take a look at that and we're back in a minute.
In Davos, there were certain statements made about India wanting foreign investments to come into the place. On the other hand, you're basically shutting off part of the overall import possibilities and trying to make India work better that way. That will not work in such a way. Increasing prices by 5 or 6% of certain components will not create an outside-in investment. What creates outside-in investment is the opportunities that you see in the market and the ease of doing business. In both areas, there have been some improvements, so I'm positively charged with that. But to think that just by adjusting a few price points here and there, you're going to increase or you're going to entice somebody to start localizing, that does not work, at least not in the luxury segment.
Welcome back. We're in conversation with Montek Singh Ahluwalia. He vociferously is arguing for the government not to hike customs duty ostensibly to make in India. He believes that that is in fact going to do the opposite and it will raise the cost structure for the economy. Before I let you go, sir, let me ask you about exports now, because the global growth and the global recovery is strong at this point in time, and India is not really participating in that global recovery on the back of its exports. Now, the economic survey also very categorically pointed out that for us to get back to an 8% plus kind of growth trajectory, we will need one of the two engines, which is the export engine, to fire up. What do you believe is the need of the hour, the key priorities that you believe the government must focus on to get exports on track?
Well, I certainly think that we ought to pay a lot more attention to exports, because that clearly has been sputtering for quite some time. And the fact that globally it's recovered and we don't seem to be quite there is double cause for worry. Now, I think there are short-term problems and long-term, short-term solutions and long-term solutions. On the longer term, clearly it's India's competitiveness. You've got to look at all the kind of stuff that's been talked about, you know, getting special export zones, encouraging export-oriented investment in these zones, providing better infrastructure, better logistics, trade facilitation. You need a lot of those things. But, you know, in the past, when we didn't have all these things, we still had good exports. So I think that the biggest thing that is wrong right now is the appreciation in the real effective exchange rate. We must do the long-term things, no question about it. But in the short run, somehow we should correct that. Because, you know, even if it's not 19% and even if it's 10%, that's a very big impact, because remember, export profitability may be only 5 or 6%. So if you've got a 10% of value compression because of a poor exchange rate, you're really killing exports. I think in addition to that, again a short-term issue, we do need to resolve the problem that the GST refunds that exporters were expecting, they don't seem to be coming as quickly as they should. And I think that's something I believe the ministry is aware of it. Whatever is necessary to get that going is crucial. But remember, on the back of a deteriorating exchange rate, if you're then clobbered with a loss of working capital because the refunds on taxes, which is your due, are not coming through, that's a very unhappy situation, and it should be given top priority.
Okay, so deal with the exchange rate, that's top priority. I'll end then by asking you, for instance, when we take a look at what the government has done on customs duty for phones, etc., they believe that that will get the likes of Apple, etc., to set up base here in India and start manufacturing in India. Do you believe that that will be the case? Because it's too important a market to ignore.
Well, you know, I can't predict what Apple... Let me put it this way. My view on this is that we ought to have a sensible import duty structure. And if there's somebody who comes along and says, I'm not prepared to come to India unless you ruin your import duty structure in my favor, we should say, well, we don't intend to do that. So, you know, you cannot convert the duty rate into a basis for firm-by-firm negotiation. That will almost certainly promote crony capitalism, because everybody who wants to come in to invest can make a credible argument that I need a tax shelter. And I just don't think we should be negotiating on that at all. I mean, remember, there are not that many countries in the world that are offering a market size of whatever it is, 600 million phone users. And quite frankly, the scale advantage that these guys are getting by virtue of being in the Indian market with a limited amount of protection, which everybody has, should be enough to bring them in. Now, in addition to that, they probably have other problems. Uncertainty about taxes, not enough land acquisition, a zillion other things. But we should address those, not start renegotiating the customs duty structure.
Montek Singh Ahluwalia, always a pleasure. Appreciate you joining us here on CNBC-TV18. That's the former Deputy Chairman of the Planning Commission, with his thoughts on why hiking customs duty is the wrong way to make in India. For now, from all of us here, goodbye. Thanks for watching.